大家好, I'm Jason Ko, founder of Ko Planning Group. I've been a financial advisor and CFP for almost 10 years now. And today, we're going to dive into the 10 steps high-income millennials can take to build and protect their wealth. In addition to closed captioning available in English, I also have it in simplified and traditional Chinese for my Chinese-speaking community. So let's get started. First and foremost, you need to establish an emergency fund. This is a safety net that covers 3 to 6 months worth of living expenses in case of unexpected events like job loss, medical emergencies, or major home repairs. Make it a priority to build your emergency fund before focusing on other financial goals. Start by setting aside a small amount of money each paycheck until you reach your target. Number 2, let's tackle high interest debt, especially credit card debt. Paying off this type of debt is crucial as it can significantly impact your financial well-being. When interest rates are 15 to 20%, this debt can quickly spiral out of control due to compound interest, trapping you in a never-ending cycle of only having enough money to pay off the interest, but not the principal. Consider using the debt avalanche strategy, where you pay off the highest interest rate first to pay off your debt more efficiently, or the snowball method, where you pay off the smallest balance first to get a quick win and stay motivated. Once you've paid off high interest debt, you'll have more money to put towards your financial goals. Number 3, define your financial goals, both short-term and long-term. This could include saving for a down payment on a house, starting a family, or launching a business. Having clear objective will help you stay motivated and focus on your financial journey. Break down your goals into actionable steps and set realistic timelines for achieving them. And if you're anything like me and are always a little bit too optimistic for your own good, whatever financial goals you set for yourself, double your timeline or however much cash cushion you think you need before taking the next step. Make sure to review your progress and adjust your plan as needed. Number 4, it's never too early to save for retirement. Maybe you're in your late 20s and 30s and you're still pretty young, or at least young at heart, but your knees make weird noises, your back is killing you, and you're getting used to your neck hurting all the time. So you start to realize that you can't keep working forever. So take advantage of your employer-sponsored 401k and 403b plans, especially if they offer a matching contribution. Additionally, consider opening an IRA for further tax-advantaged retirement savings. If you earn too much money to deduct your IRA contribution and earn too much to contribute to a Roth IRA, then consider a backdoor Roth IRA. You can watch the video I made about that strategy, links in the description below. Another benefit of starting early is you can have more time for compound interest to grow your initial investments. So you can either retire earlier, retire wealthier, or use your investments as leverage to pursue something you are more passionate about. Number 5, you've put your money into a retirement account. The next step is to invest it. The wealthiest people in the world all have built massive businesses, but if doing that is not in the cards for you, and if you're like me or a little bit lazy after a long day at the office and watching the kid, then the next best thing is to own a piece of those businesses as a passive investor. Every day, the stock market provides you with the opportunity to own a piece of an established business like Microsoft, Tesla, Apple, ExxonMobil, Johnson & Johnson, Visa, Home Depot. The list goes on and on, but it is not necessary to pick individual stocks to get a good investment outcome. Start by building a diversified portfolio using no-load mutual funds or low-cost exchange-traded funds, ETFs, to invest in stocks, bonds, and other investment vehicles. This will help minimize risk and maximize returns. And remember, the stock market movement is totally random and unpredictable in the short term. So to achieve good investment success, it is all about playing the long game, staying diversified, having time in the market, and not timing the market. Number 6. A great way to accomplish all this is through automation, because once you set it up, it's like having little minions doing your job for you. Set up automatic transfers from your paycheck to your savings, investment, and retirement accounts. This will help you prioritize saving and avoid the temptation to spend. By automating your saving, you're effectively paying yourself first, which is a key principle in personal finance, because now you can spend the money that is left over guilt-free. Number 7. Review your expenses. Like I mentioned in the previous point, I prefer to take a more top-down approach to saving first and then spend what is left, because I am not a fan of having to think and worry each time you want to buy something. But it is pretty insightful to track your expenses for 3 months just to see where it's going. This will help you identify areas where you are spending money and not getting any value out of it. Have you signed up for a gym membership in January and you found out you're not really going to that? It's time to cut that out. If you are spending a lot of money eating out, maybe sign up for a home cooking meal subscription plan as a nice middle ground between eating out all the time versus cooking all your meals from scratch. And now a word from our sponsor, HelloFresh. Each week you get to pick from over 50 menu and... Just kidding, guys. Let's move on to number 8, plan for your taxes. High-income millennials like yourself need to be strategic about taxes since it can easily be the biggest expense you have. So work with a certified financial planner or a tax professional to help you identify deductions and credits that can help keep more of your hard-earned money. Common ones include maximizing your healthy savings account, your 401k, your IRA, take advantage of a dependent care FSA if you have it. Remember, these are all government-sponsored plans, so take advantage of them. Don't pay any more taxes than you need to. Number 9, insurance. This is a topic I see many financial content creators completely ignore, but insurance is critical to your financial plan because none of the long-term wealth building strategies matter at all if you have a tragedy today. So don't forget to protect your family and assets with proper insurance coverage, like life insurance, disability, homeowners insurance, and general liability insurance. This will provide peace of mind and financial security in the event of an unforeseen circumstance. Remember to periodically review your insurance policies to ensure that they still meet your needs as your financial situation evolves. And finally, continue to educate yourself on personal finance topics. Stay informed on market trends, new investment opportunities, and changes in tax laws. Maybe you already work with a financial advisor, so you don't think you need to learn all of this, but if you're apathetic about your own personal finance, how can you tell the difference between a good or bad financial advisor? So never stop learning, because the more you know, the better equipped you'll be to make smart financial decisions. And that's a wrap on the top 10 financial steps for high-income millennials. I didn't even cover estate planning, which is just as important as insurance, so stay tuned for when I talk about that. If you found this information helpful, please like, share, and subscribe for more financial insights. Don't forget to leave your questions and comments down below, and I will personally answer them. Let's plan together. Joaquin.